Hi, I'm Sonia Munder, a tax director here at Wilson Partners. I joined the firm back in April 2025 and advise individuals, families, and trustees on a wide range of private client tax matters. I'm a chartered accountant, chartered tax advisor, and a trust and estates practitioner. So I tend to advise individuals who are moving to and from the UK. Today, we see that people are more and more globally mobile. That kind of involves them having international careers. They might do remote working across borders, have multiple homes in different countries, people who are looking to expand their business globally, and generally individuals who move for, say, education, finance, or even tax reasons. My key message to clients would be to take early advice. It can firstly help you avoid any inadvertent tax implications or charges. And secondly, it means you can plan your affairs tax efficiently. So here in the UK, tax residency is determined by looking at our statutory residency test, known in short as the SRT. This is split into three buckets: the automatic overseas test, automatic UK test, and the sufficient ties test. These tests are looked at in order. You look at an individual's time that they've spent in the UK, but also other connections that they have to the UK as well. So a common misconception tends to be that staying under 183 days or even 90 days means that you're not going to trigger UK residency. However, that's not the case, and it's important to look at other factors such as where you work, where your homes are located, and the time that you spend in those homes, other accommodation that's available to you, where your family is, and also your UK residency history as well. Under the residency rules here in the UK, we also have something called the split year tax treatment. Here at Wilson Partners, we can help you understand those rules and make the most of them. In a UK resident tax year of either arrival or departure, you can split that year so that you have a UK part of the tax year and a non-UK part of the tax year, and you can benefit from tax treatment as a non-UK resident in that non-UK part. Your UK tax residence position impacts your exposure to UK income tax, UK capital gains tax, UK inheritance tax under new rules, and also it can impact things like companies that you're involved with, trusts that you're involved with, and also it's important to consider a number of anti-avoidance provisions, one being temporary non-residence, where individuals leave the UK and return shortly after, usually within 5 full tax years, which can have significant tax implications. So UK tax residency now can impact your inheritance tax exposure under new rules which were effective from 6 April 2025. Inheritance tax was previously determined by your domicile status. It's now determined by your residency status. And what this impacts is your exposure to inheritance tax in the UK. And what you might want to consider is reviewing your IHT position under the new rules, look at estate planning, potentially restructuring your tax affairs in accordance with those new rules. At Wilson Partners, we can help you plan your move to or from the UK tax efficiently, assess your UK tax residency under the statutory residency test, and navigate things like split year tax treatment, anti-avoidance rules that might be relevant to you. We can also assess your UK inheritance tax exposure under the new rules. And importantly, we can work with your overseas tax advisors to ensure that your worldwide tax affairs are managed appropriately.